Hello, everybody. This is John Llodra, reaching out for our weekly video here from New Harbor. And with me, hopefully you can see perhaps a new and maybe unfamiliar face to at least some of you, is Michelle Moss, a recent addition to our team. And hopefully the name at least is not an unfamiliar name to you, but this is the first time Michelle will be joining one of our videos out to clients. She's done plenty of one-on-one meetings with clients and prospective clients. But hello, Michelle. Everything working on the audio visual department there?
Yes. Hello. Nice to be with you all.
And of course, Michelle and I are about 10 feet away from each other, so we're not only connected via the video here, but we're literally in the same office as our team often is. Well, so we're glad we did a seminal video, I suppose, a couple of weeks ago. Mike Preston sent out a video. It just so happened to be a week where our usual weekly video with our good friend Adam Tagger at Wealthion was not able to happen because of his mom's last stages of life. But we did hear from clients that they very much welcomed and look forward to our weekly updates. So that actually gave us an opportunity to start something here that we intend on continuing. We got great feedback, and really our purpose here is it's manyfold. It's to not replace, but actually supplement the video work that we do with Adam at Wealthion. But we hear from our clients all the time that they really like the kind of directed communications that we can direct directly to them, because our clients are a great subset of the world, and we're very fortunate to have you as our clients. So the purpose of these videos, which we'll send out probably weekly, is to not only speak directly to our clients, but to cover a range of topics that are maybe more focused or directly focused on some of the specific feedback and questions we get from our clients. And of course, this gives us an opportunity to not only directly answer those questions and speak to what's important to our clients, but to broaden out the scope a little bit in terms of the topics we'll talk about. And we really want your feedback to be able to do that in a way that covers the things you want to hear, but also very importantly to introduce our clientele to a broader section of our team. Myself and Mike Preston and Christine Driscoll and Justin Griffin, we have been a long-time team here at New Harbor Financial, and we're so glad that through the growth of our business, we've been able to likewise grow our team. Michelle being one recent example. You've met Katie Shield, at least hopefully over the phone. And we're going to just maybe even today send an announcement of our latest new team member, Regina. And Regina is doing many things for us, but one of the things she specializes in is our digital marketing and client engagement so that we can interact with our clients. So this video, as rough as Michelle and I will leave it, Michelle will do her very best. Regina will do her very best to turn it into something that looks of the quality that you, our clients, deserve. And we're going to be mixing up the folks who kind of do these videos, either due to travel or certain topics that we feel are best suited for one or the other of our team members. Sometimes they'll be solo, sometimes they'll be collaborations, all in the spirit of making sure that you've got a full team here at New Harbor working on behalf of you, and that's available for you. All right, so enough of the intro here. We'd like to keep this short and sweet. Of course, we can't do a video like this without talking about financial markets and some of the financial matters that we speak to our clients about quite often. So the market this year, the market headlines, and if you tuned in, has been up quite strong. And this is in a backdrop, and I'll get into a little bit more in detail of how that strength isn't so healthy as it might appear on the surface, because it's against the backdrop of a very noticeable and systematic degradation in the economic picture. So we have a few slides here that we'd like to share just to kind of put in picture some of the things that we take into our discipline for our clients. So if all goes well, I'll be able to share my screen here and you'll see some pictures. Okay, so hopefully that's showing okay. And Michelle, give me a thumbs down.
All good.
Okay. So this is a slide. This is basically, there's a concept called leading economic indicators, and there's a whole battery of things that go into this. Things like new orders of manufactured goods, employment factors, things like that, even though many measures of employment are lagging indicators. But what you see here is a chart that goes back to 1960. And you see here in kind of the current last several months, this is up through May of 2023. This hasn't yet been updated for June, but it sets a pretty clear picture that we've had a battery of leading economic indicators declining relative to the current coincident economic index. Forgetting all this, the economist babble, what this frankly means is that across a range of measures of economic activity, there's a noticeable deceleration. And we can't help but look at the context of this in terms of history. If you look in over the past long history, when you get these pronounced declines, you'll see they coincide with these gray areas, these gray shaded areas, and those happen to be official recessions. The most recent recession, this very narrow one here, was in March of 2020 due to COVID. So we're definitely seeing a economic slowdown, and of course we think that may very likely lead, as we get further to the summer into the fall, more pronounced decline in economic activity. Of course, we think that will have market implications, as stocks in general are very, very overpriced. In fact, some measures have rarely ever been higher. In fact, the only times in history that on some of these most reliable metrics have rivaled where we are now as a broad statement, S&P 500, for example, was in the tippity top of the tech bubble of 2000 and way back in 1929. So we are in very rich territory. But this chart basically shows the year-to-date performance of the S&P 500. Here is 14.92%. That's through, I think, June 27th. We're recording this on June 28th. And what many folks don't realize is the S&P 500 is what's called a market capitalization weighted index, where the larger the company is, larger the market value of the company is, the greater the influence on the index it has. Now, the problem with that, or the thing to be very aware of, there are a handful of stocks that comprise a very large portion of that index. In fact, if you look at these 7 stocks, Apple, Amazon, Tesla, Facebook, Meta Systems, Google, NVIDIA, and Microsoft, those 7 stocks have recently been labeled the Magnificent Seven, no small part because year to date, they have absolutely just gone bonkers. And we'll debate anybody all day long on the fundamental metrics as to whether this rise has been justified. We think categorically no. NVIDIA, for example, was trading recently as high as 40 times annual sales, which quite simply means that every dollar of revenue had to be given to shareholders without paying any salaries or cost of equipment or anything like that to justify that valuation. And interestingly, if you simply take the same 500 stocks in the S&P 500 and look at them as equal weighted instead of the regular index that has these stocks disproportionately driving the index, you have a much lower 5.35%. In fact, right through the beginning of June, that market was not even up. It was basically flat in the air. So very disparate market, not a healthy thing if history's any guide, and is oftentimes emblematic of a blow off top in a bear market rally. We can't know for sure, but this is the evidence that certainly rhymes with history. We are always looking for signs of a broadening of market rallies. That is a healthy thing when market rallies do broaden out. When they're narrow, it's very unhealthy. And recently, this chart basically shows a ratio of the Russell 2000, which is a small and mid-cap index, much broader, 2,000 stocks instead of 500. And recently, so this decline here basically just shows that the S&P 500 was accelerating upwards in a much faster pace than the Russell 2000 until just recently in June. And we suddenly had the Russell 2000 start to play catch up. That on its own, if it were to continue, would be a check box in the somewhat healthier category, irrespective of market valuations. But what we've seen is very quickly that has turned over. So, what seemed to be at least a broadening by this measure seems to have stalled. So we're still very, very much on alert for that. The other thing I want to say, beneath the surface of the market, our discipline, we're always looking at different sectors and areas where we think there's good value, even despite overvaluation. And there are sectors that we do. For example, we've talked frequently about gold mining stocks and whatnot. But we've seen, for example, just recently in the last handful of days and weeks, a very significant and notable increase or strengthening in the industrial sector, old school manufacturing and industrial stocks. So we're very intently looking at that and may quite likely put some exposure on perhaps even within hours or a short number of days of this recording. All to say is that we're very open-minded and observant for areas of potential, even against the backdrop of an overvalued market. I'm going to do one more slide here, and then we're going to go off the slides and get back to our faces. This is just a slide that basically speaks to a couple things. First of all, what we've seen over the last year, this blue line here is the 3-month Treasury bill rate. Most of the past decade, it was at zero. There was a tightening campaign by the Federal Reserve to raise interest rates that into 2008 that they quickly had to reverse course on when COVID happened. But in the last year, since about March of last year, we've had a very sudden and steep rise in interest rates by the Fed, which has given rise to cash equivalents like Treasury bills, which we, on behalf of our clients, hold quite a large portion of because we think it's a great place to be right now because they're yielding north of 5%. And if you compare that to the effective yield, there's a notion of what's called an earnings yield on the S&P 500 that, there's a way to compare the relative yield attractiveness. And both the S&P 500 and corporate bonds have effective yields lower than 3-month T-bill rates. So in the backdrop of a very overvalued market, we think and have continued to think for some time that having a big portion of clients' important money, which is pretty much all of our clients' money, in very safe and liquid things like Treasury bills, because pretty decent yield, but we also have the opportunity on moment's notice to liquidate without any problems those Treasury bills to divert into other types of assets. So I'm going to stop sharing the screen for a moment, and Michelle and I can kind of take the conversation. Michelle, I don't know if you want to kind of share any thoughts to tie some of those together. And of course, what we're trying to emulate here for you all is a little bit of a glimpse of how we work as teams here. We spend a lot of time collaborating, Michelle and I, and Mike Preston and Justin Griffin. We are the foundation of our investment management committee. Mike and I lead it, but Justin and Michelle are very important contributors, and we challenge each other, and we hope to give a little bit of a dynamic of that interaction here today. So any thoughts, Michelle?
Yeah, I think you summarized it really well. And I think that a lot of people have been feeling that it's a tale of two cities, the real economy versus the financial markets. So we're really watching it and just looking at all the indicators and kind of looking at a convergence of different factors to kind of know where to be next.
Well, great. Thanks, Michelle. So one of the things that we'd like to tie in is a little bit of a glimpse of some of the very common questions. We get questions and calls from clients all the time. We'd love to get them on things well beyond financial markets and things that really translate or kind of speak to their everyday life decisions and things that we don't manage for them per se. But Michelle and I were talking about some of the range of things that we've talked about with clients about recently, and one that's been a very persistent topic, and for good reason, and frankly it's not just recently but over the last couple of years, is the whole topic of housing prices. And given the rise in interest rates and the COVID dislocations, it's a very complicated, interesting, you might say, dynamic in the housing market. And as a recent relocatee, I think is the word I'll use, if that's even a word, Michelle moved from New York here to Massachusetts to be with us as part of our team. So she's got some firsthand experience that she can probably weave in. But Michelle, why don't we give a little chat about the housing market and some of the observations. We do have a couple of charts we can kind of bring some data to, but why don't you kick us off there?
Yeah, I've been having a lot of conversations with people recently about the housing market, and it's very real for me too. So I sold my house in New York, and I actually did it without putting my house on the market. And I had kind of an inside buyer that I knew. So I know that not all transactions happen by listing a house. So there may be some deals there available for people. But really, the housing market has been quite resilient compared to what people perhaps expected. And it seems that the supply is really low. and the demand is still there. And so people are kind of wondering when's a good time. And so it's the housing market is a lot slower moving than the stock market. So I think that it's important to be patient and flexible, and sometimes renting in between that transition can kind of help take the pressure off, especially if you're not familiar with an area, to just kind of buy yourself some time, get used to things, and then really be able to really like be patient about when you actually buy something that's often a pretty big purchase compared to your financial picture. So I think that another thing that comes into the play is interest rates. And sometimes people, some realtors and people in the industry, the mortgage industry, will maybe suggest that interest rates might drop soon. We tend to think that they're going to stay pretty high until there's real economic pain, which is not really bullish for asset prices. So I think that it's important to just kind of assume when you're entering into a new mortgage, just don't bank on refinancing too soon. You want to make sure that your payment is reasonable for your cash flow.
Yeah, Michelle, if I could talk, you're speaking of patience and time really gets to one of the obviously the key natural questions that clients and prospective clients have of us is when is the right time to, I've been renting and I really want to settle down in a house, and if I know they're not going to go, prices aren't going to go lower, why would I wait? Or, if they go higher, should I buy now? And obviously we can never answer with precision the when, but there definitely is cycles of things. And Michelle spoke of interest rates being a key factor. One of the things that we counsel clients and a house is a financial, thing, right? You drop a ton of money, maybe oftentimes take a mortgage. So it's a financial creature. But it also is a different kind of asset because it's a place you live. It's a place you might find stability and comfort, and a place to raise a family. So it's not always a financial decision. But Michelle talks about the flexibility. There's value in deferring a permanent decision like that. But we want to share a couple charts because there has been some very modest, encouraging news on a national scale from the housing standpoint, but as the old cliche goes with real estate, it's all about location. So local markets, as unfortunately Michelle has found here in Massachusetts, can actually be quite different than even some of the improving trends on a national basis. So we'll share a couple of charts and then we're going to wrap it up, and we want to make sure we can keep these short and sweet and to the point. But let me share again a couple of charts that we pulled together. You want to talk this through, Michelle?
Sure. So this is the Case-Shiller composite. It's a year-over-year comparison. So basically, it shows that right now that prices actually have gone down a little bit in 2023. So really, and the last time on this chart that house prices were the year-over-year prices had gone down was really after the great financial crisis.
Yeah, 2012 right here is the last time. And just to be clear, this line right here is the 0% mark. Anytime it's above that, it means there is some positive increase in price year over year. So we've gone from 2012 through just now, basically over 10 years, where there have been pretty consistent national increases in housing prices. This is the first little blip on a national level that prices have moderated ever so slightly. But again, back to the location. Looks like Michelle, got out of New York at a good time. Michelle, you can talk through this chart, but it just speaks to the differences in location.
So basically, we can still, so the orange line is San Francisco and the blue line is New York. And the San Francisco houses have been quite high, but they've been trending down a bit. It's more one of those cyclical markets. And then New York is kind of maybe not catching up, but it is trending up a little bit. I think that other areas in the Northeast, we're kind of seeing that they've stayed pretty strong.
And then, of course, we'd be remiss if we didn't properly look at the bigger picture. And just because prices maybe have dropped a little bit or moderated doesn't mean houses are deep values right now. And Michelle pulled this chart together, and why don't you comment on that, Michelle?
Yeah, this is one of my favorite charts because a lot of people are comparing what we're seeing now to the housing bubble in 2008. And it's a different dynamic because there's different types of loans. So I think that there's not as much leverage, but when we look at the prices are really, when you compare them to the household income, they are higher than we saw at the top of the housing bubble. And that just speaks to the lack of affordability for the average American.
So we'll be watching closely. Obviously, this is part of the broader economic picture and interest rates. I wanted to comment a couple things. We have a couple of holdings in client portfolios. We have a small, relatively modest piece in long-term bonds, treasury bonds, because we do think there's quite a possibility of in the near term, longer term interest rates moderating a little bit to the downside, which may be helpful to mortgages if we see a deeper recessionary impulse start to set in. So that's to be determined. But we do have those hedged in a way, if there's further weakness in longer term bonds. But again, we only have about a 15% allocation there. And then we do have a core position in gold mining stocks that have struggled recently, and we want to acknowledge that, and that we do also have hedges in place fairly tightly close to where those prices currently are. So we're very mindful of the to's and fro's, and we want to look for ways to progress client portfolios, obviously, but without taking undue risk. And I mentioned, we're seeing some sectors and industrials and things like that are looking to possibly be an area of fertile ground, even in the broader, very overvalued stock market. I think it's mostly what we wanted to cover today. This is going to be an ongoing thing. And we always invite your questions, feedback, comments, even constructive or critiques. That's a nice way of saying, hey, do this better. And we're all ears. We'd love to hear from you. And we're speaking on behalf of our whole team, myself, Michelle, Mike, Christine, Justin, Katie, and Regina, our growing team. We'd be remiss if we didn't just give you a save the date reminder. We are going to do a live Q&A over this format for our clients, and it's going to involve a number of our team members, maybe all four of the financial advisors on our team, myself, Mike, Justin, and Michelle. But the tentative date for that is July 11th, Tuesday, July 11th. Regina will be coordinating that day, and in advance she'll be sending out some save the date and promotional items, but in that will be a format for you also to share with us any questions you would like to make sure we answer during that Q&A, and any other thing you'd like to share with us. But thank you all for watching and listening. We hope this feels like a personal way to connect with us, and we look forward, our whole team looks forward to doing plenty more of these in the future, as well as the ongoing work we do with Adam at Wealthion, a longtime collaborator of ours over a decade, and we're very grateful to be able to reach you all in this way. Michelle, anything else you want to close with here?
Yeah, I just wanted to say thank you. So nice meeting you all, and looking forward to continuing to stay in touch.
Okay, thank you all, and happy 4th of July weekend. We're approaching that, and we hope you all have a pleasant, hopefully long weekend. Goodbye for now.